On July 2nd, Palantir closed at $129.30, up 2.84%. That same day, D.A. Davidson analyst Gil Luria upgraded the stock from neutral to buy and raised his price target from $165 to $175. $175. That's 35% above $129.30. Luria's reasoning sounds bulletproof. Palantir's AI orchestration layer is shifting from a nice-to-have to a must-have. Anthropic's fallout with the US government, which forced its models offline, sent a chill down enterprise customers' spines. Who would still dare to tie their business directly to a single AI model provider? Palantir's model-agnostic positioning hits that pain point perfectly. The logic is solid, the story is compelling, and the price target is tempting. But the K-line says one thing: I don't buy it. Open Palantir's daily chart. What's the first thing you see? All four moving averages are sitting above the stock price. MA5 at 126.84 is barely holding below. That's the only fig leaf. MA10 is at 134.35, MA20 at 139.19, and MA30 at 148.31. At $129.30, the stock is pinned down by all four moving averages. This isn't coiling for a breakout. This is a textbook bearish alignment. What's more striking? Palantir has dropped more than 29% year to date. In June alone, it fell 25.47%. From its May high around $175, it plunged all the way to $114.57 at the end of June. A 14% up day is called a rally, but against a 35% drop, it's not a reversal. Luria said the valuation has rationally come down from 250 times PE to 71 times. 71 times. In what world is 71 times reasonable? In the world of AI storytelling, in the world of K-lines, valuation mean reversion is never done by reasoning. It's done through price declines. What happened to Palantir on June 29th? It opened at $116.23, hit an intraday low of $114.57, then violently rebounded to $132.88, finally closing at $129.30. Volume, 202 million shares. Turnover, 9.35%. That means 1 out of every 10 shares changed hands that day. Who was selling? Institutions that built positions above $175 and those who panic cut during June's plunge. Who was buying? Retail traders who jumped in after seeing the 14.5% rally, and FOMO-driven investors who got excited by the analyst upgrade headlines. Those 202 million shares lifted the price from $114.57 to $132.88. Then it faded back to $129.30 at the close. If you bought at the intraday high of $132.88, you were already down 2.7% by the bell. That candlestick is called a bull trap. The technical camp will say, look, RSI is already at 34.4, nearing oversold territory. Historically, these levels often produce a mean reversion bounce. True, but a mean reversion bounce doesn't change the trend. Palantir is currently trading below both its 20-day MA and its 50-day MA, confirming a clear intermediate-term downtrend. The 20-day MA is sloping downward, repeatedly capping every bounce. Oversold not equal to bottom. In extremely weak markets, RSI can stay oversold for a long time. Traders are watching the $124 support level and $128 resistance very closely. A break below $124 would open the door to further downside. A move above $128 could trigger a short-term bounce toward $130. But remember, a bounce is not a reversal. Until the price clears $135, every rally is just a dead cat bounce. Is Luria's logic flawed? No. Palantir's ontology does have unique value. Model orchestration is indeed becoming a critical need, and 85% revenue growth is real. But a great company is not equal to a great price. From $175 to $129, Palantir's valuation has gone from crazy to still expensive. A 205 times trailing PE, 71 times forward PE, that's not a value trap, it's a faith tax. Luria made an interesting comment in his report. Palantir has gradually matched its valuation. Translation: the stock dropped 29%, so now it's less expensive. What if it drops another 29%? Would the valuation be even more reasonable? The K line never lies. It only tells you one thing, where the money is flowing in and where it's flowing out. If you have a position at $129.30, this is not the bottom. Above $134, MA10 is the first hurdle. $139, MA20 is the second. A rally to $134 to $135 is a chance to reduce your position, not a signal to add. Set your stop at $124. If it breaks, get out. If you're looking to buy, wait for the price to retreat to the $114 to $116 range, the June low. Wait for volume to dry up and wait for RSI to show a bullish divergence. Don't catch a falling knife at $129. The 202 million shares of trapped holders are still hanging over your head. First entry zone, $114 to $116, June low area. Position size no more than 10%. Second entry zone, $100 to $105, if it truly crumbles. Position size 20%. Third entry, wait for a confirmed close above $135 on rising volume. Then we can talk about a trend reversal. The analyst's $175 price target, until the K-line confirms it, it's just a number on paper. The AI story isn't over, but the valuation bubble can burst at any time. The analyst's $175 and the K-line's $129. Which one do you trust? I trust the K-line because big money never listens to stories, and as retail investors, we shouldn't either. Palantir is a great company, but even great companies can see their stock fall. From $175 to $129 took less than 2 months. If the trend continues, $129 to $100 could happen even faster. Don't treat an analyst's price target as a guarantee. It's just one person's opinion. The K-line is the market's voting machine, and right now the vote is clearly in favor of the bears. Wait until it clears $135. Then we'll talk about the $175 story. Until then, cash is king. Be patient.